Hey, what's up guys? It's Jim Tay. This year has passed by so quick. We're already into August. It's been a really eventful year with plenty of market activity and continued strength in the Singapore property landscape. So in today's market update video, there's plenty to cover. I'll be talking about the hot topics right now. Inflation, how it links to interest rate, how there are methods to reduce the impact of interest rate hikes, look at household affordability to assess just how much of an impact higher interest rates would really have. I'll also share my thoughts on what might buyers be thinking. Will the resale market soften? Will developers drop their price? And finally, what should you do as a buyer or an investor in today's market? I'll also be sharing one key statistic which will shock you. Before I dive in, a disclaimer. I'm not an economist or financial analyst, although I did study business at NUS. If financial advice is what you're looking for, you won't find it here. So please speak to your own financial consultant. I am in fact a licensed real estate agent in Singapore, and my main job is to represent you to buy, sell or rent any properties and earn a commission. If it's your first time watching my videos, there's a link in the description to learn more about me. Do get in touch if you like my work and want to support me. I'll greatly appreciate it. If you're pressed for time, feel free to double up this video speed or use the timeline to skip only to the sections which interest you. Enjoy content like this, make sure you smash the like button, subscribe, hit the notification bell so you don't miss any upload. With that said, let's dive right in. Keep watching. Starting off with the relationship between inflation and interest rates, let's take a look at this chart which shows the inflation rate in America. We can see that the current inflation is the highest over the last 10 years. Astoundingly, even if we go further back to 25 years before the 2008 global financial crisis, inflation is still the highest it has ever been. In fact, the last time inflation was this high was back in the 1980s. While some inflation is good, 2 to 3% being a common target among nations, too much inflation is not desirable because it means prices are rising too fast, effectively devaluing the cash we have on hand, and often wages do not rise fast enough. Singapore is not spared from this either, with the consumer price index for all items hitting a high of 6.7% in the last June data. A DBS study has also shown that income is not keeping pace with inflation for 4 in 10 people. Hence, we need to control inflation, and this is done by, you guessed it, raising interest rates. How then does rising interest rates control inflation? Since I'm in property, let me give you an example using housing interest rates. So, when housing interest rates go up, monthly mortgage repayments increase. When we then have to pay more back to the bank, we have less money remaining to spend on other products. Reduced spending reduces demand and therefore prices come down, reducing inflation. Now that you have that basic knowledge, let's look at the current interest rate environment in Singapore. Courtesy of POSB, this is a table that shows the 3-month SORA rate from January to August of 2022. We can clearly see that it's only gone in one direction since the start of the year. I won't go into detail of what is SORA, I'll have a link in the description for that. Just know that most floating home loan packages in Singapore are SORA pegged, meaning the current home loan interest rate is based on the SORA rate plus an interest rate spread. Putting it simply, you can think of the SORA interest rate as what the bank would earn risk-free on their funds should they not be lending it to you. When they lend it to you, the spread is the additional margin they need to account for the risk. Let's look at some banks' home loan packages in Singapore with reference to moneysmart.sg. We focus on DBS, where you can see that the home loan rate would be the 3-month compounded SORA plus a 1% spread for 3 years. So, if you were on this package since the start of this year, this is how your actual interest rate would have changed to date. An increase from 1.194% in January to 2.271% today. That's almost double. For a 30-year loan tenor with loan amounts of 1.5 and 2 million, this table illustrates the estimated change in monthly mortgage payments. While maybe still manageable for most families, it's not an insignificant amount and it can mean less dining out at fancy restaurants. Especially with interest rates still expected to rise even further, let's look at some ways to reduce the impact of interest rate hikes. The first way is to reprice or refinance your loan. If you're not familiar with the terms, repricing means signing a new loan package with your existing bank, while refinancing means signing a new loan package with another bank. In the process, you can extend your loan tenor. What this does is it spreads your mortgage loan amount over a longer period, effectively reducing the monthly repayment. The number of years you can extend to will usually depend on your age and how long your loan has already run since inception. For illustration purposes, I'll use 35 years as that is the maximum loan tenor possible. You'll notice the savings can be quite significant, offsetting much of the actual increase from the interest rate. Note that you can also opt for a 35 years loan straight off the bat when making a purchase, but it means your maximum loan to value is 55% instead of the usual 75% for loans up to a 30-year tenor. The second method is to reduce your loan amount. Have additional cash sitting in your bank that is being eroded by high inflation, or even surplus CPF ordinary account savings. You may want to use these funds to reduce the loan amount and hence the mortgage repayments. Just make sure you remember to only do this when you're out of your lock-in period, when repricing or refinancing, otherwise there will most likely be early repayment penalties. The third option, sign an interest offset mortgage package. These type of packages have been available in the market for a while, but was never popular for a long time due to the low interest rate environment. So it could be the first time you're actually hearing it. In reality, this interest offset package does not reduce your mortgage repayment amount. It does, however, decrease the portion of your repayment that goes towards paying the loan's interest. Essentially, you'll be paying down your loan principal amount faster. Only a few banks in Singapore offers this, Standard Chartered being one of them. I won't go into much detail on how this package works exactly. I'll have a link in the description to their page, the bank's website, where you can learn more about how it works. Moving on, understandably, there is some concern among market participants about how rising interest rates would affect household affordability. By now, we know that when we take a mortgage loan in Singapore, our loan amount is subject to TDSR assessment, which means that our monthly repayment has already been stress tested to an interest rate of 3.5%. The question I want to answer is, at what point will affordability be affected? This is not an easy question to find an answer to, but I found an article in the Business Times on the 11th of July which I think did a pretty good job. Let's take a look. Within, we focus on Table 2, which shows the interest rate tipping point where the top 30th percentile in household income would not be able to afford 1,000 to 1,002 square feet non-landed residential property in the OCR and RCR regions. Looking closely, these are the rates mortgage interest would have to reach before affordability truly becomes an issue for buyers. At the moment, we haven't even reached the first mark of 2.5% for new sales and 3.5% for resales. Though that may change following the likely next rate hike in late September, the subsequent tipping point of 4 and 5% for a 25-year loan tenor may not be reached just yet. That's because inflation in the USA has shown signs of easing. Yay! With July data coming in below market expectations. Interest rates may therefore stabilize at around 3% going into 2023, with some analysts even predicting interest rates to be cut again towards the end of next year. In summary, is affordability affected? At current rates, I think it's a definite no, as regulations have already accounted for rates as high as 3.5%. Only if interest rates go north of that, towards 4% and higher, will we likely see affordability concerns. Will that happen? It's anyone's guess, as a lot depends on the economic data coming out from America. Now, we're doing just fine. More importantly, I want to look at a bigger question market participants have. Will the high interest rate situation cause prices to fall? Will the resale market soften, or will developers drop their price? First, we look at the resale market to try and answer the question. Earlier, we established that repayments spread across decades of loan tenor do not increase significantly. Crucially, how about relative to income growth? This time, I don't want to look at graphs or plot indexes, as each period can have widely different circumstances and it may not be the most relevant. Let's instead use the total wage change by sector data that was just published by our Ministry of Manpower in end May. From there, we can see that wage changes by sector across 3 years from 2019 to 2021 range from negative 5.3 to 5.6% per annum. I can be very conservative here and only count a gross 3% increase in wages for any buyer since their purchase, be it in 2021 or further back since TDSR was introduced. Take a look at this table, which shows the required income for a buyer for a loan amount of 1.5 and 2 million respectively, inclusive of a $1,000 monthly car loan repayment. We take a 3% increase in the income, we find that the absolute dollar increase in wages is able to cover the higher mortgage repayments required. Realistically though, it's more likely that these homeowners had an even larger increase in income than 3%. For investors holding onto rental properties, the strong rental market further provides firm cushioning from urgent sales. This rental trend is expected to continue for the remaining of the year. Therefore, for buyers who have been waiting for fire sales, you've been waiting for years, probably even through COVID. I would say most likely the wait continues, or at the very least it won't happen because of high interest rates. Even if that has some impact on affordability, it likely wouldn't pressure owners in wanting to let go fast. Probably that makes sense and explains why volume is falling, because buyers are holding back, while at the same time prices are still increasing because sellers are holding firm. Maybe if there are severe crashes in certain sectors, like crypto that resulted in billionaire Chu Su having to sell his Bukit Timah good class bungalow, or more significantly, massive layoffs due to a bad recession, then these urgent sales would appear. On the other hand, for new developer sales, unsold supply has been steadily dropping since a high of 36,839 units back in first quarter 2019. As at the end of second quarter 2022, the supply remaining unsold has effectively more than halved to 15,805. Although on the surface, it looks like there was a bounce since the low of quarter 1, if we look closer at the details, much of the increase is due to units that have planning approvals but are not yet ready for sale. Another metric that bargain hunters like to look at is the developer 5-year ABSD deadline. When we analyze the existing available stock of new units for sale on the market, projects with an ABSD deadline this half of the year have already sold close to 99% of their existing stock. Only one project appears to be at a higher risk relatively to missing the deadline, with just over 50 units still available. Projecting forward to next year, 2023, we look at the first and second halves. You'll see that the sold percentages are at 93.5% and 78.2% respectively. Projects here highlighted in bold are the ones at higher risk of missing this deadline. Truth is, this 5-year deadline is not something new, and there has been instances before of developers slashing prices greatly at the last minute to clear stock. While certainly it could happen again, I always advise my clients not to take attractive prices at face value and to look deeper and ask questions like, why did this unit remain unsold? Was it too overpriced to begin with? And if you're buying for short term especially, what factors can cause the price to bounce back quickly in the near future? Similar to auction properties, I have seen one too many a buyer jump in too quickly to what appeared to be good deals only to regret it later. Another key reason that underpins the strength of our real estate market is Singapore's continued attractiveness as a safe haven. I mean, come on. When facing a national crisis of all places in the world, the Sri Lankan president chose to come to Singapore when fleeing his country. One of the richest men in Mongolia pays a record price of 5,800 per square feet for a unit in Le Nouvel Art Mall. 6.3 billion in fixed asset investments have come into Singapore in quarter 2, projected to create over 5,000 jobs. Was the foreigner ABSD tweak in December 2021 to 30% meant to deter foreign buyers? It seemed to have in quarter 1 of this year before surging back up in quarter 2. A nice additional 10% tax collected by our government. Fact is, according to Henley and Partners, a migration consultancy firm, Singapore lists among the top 3 locations in the world for millionaire migration. The COVID-19 pandemic has done nothing but enhance our reputation as having strong governance and increase our attractiveness as a safe haven. We rank right at the top of a recent survey done by Pew Research Center, a think tank based in Washington. And if all this wasn't enough, an update on the latest Singapore household balance sheet data reveals a key statistic. The net cash position of Singapore households has increased by a whopping 18.2 billion since the end of last year. To put this amount in context, remember the recent launch, Amo Residence, which was almost fully sold on day one, 98%? It has a total gross development value of around 730 million. Which means this additional liquidity can buy the entire Amo Residence 27 times over. Wow. Significantly, it has also crossed the 200 billion mark for the first time. In summary, buyers looking for fire sales, you may find the odd one here and there, but largely your wait will probably continue as the market chugs along. At least for the upcoming 6 months of the year. Make sure you subscribe to my channel and turn on the notification bell so when I release my next update, you won't miss it. Finally, on to my last segment. What should buyers or investors do? First, are you over-leveraging? With interest rates still likely to rise further, make sure you account for the higher monthly repayments in your financial planning. While loan-to-value and TDSR are useful regulatory measures to keep things under control, the higher interest rates might push beyond the threshold 3.5%. Hence, there could be changes in the regulatory framework for TDSR where a higher rate would be used to determine loan eligibility. Maybe 4.5 or even 5%? Come on, some people are even predicting it for it to come during this Sunday's National Day rally by our PMD. The implication, of course, if you're a buyer who wants to take a higher loan amount despite this higher interest rate environment, you should get your loan confirmed before this potential change. Are you concerned that there might be a downturn? While available data currently says it's unlikely, some cautiousness never hurts. As this chart shows, we bounce back from every recession and property prices will reach new highs again. Make sure you adopt a long-term outlook. The COVID-19 crisis accelerated price increases in Singapore, leading to outsized gains for many investors within a short period. Realistically, this pace cannot continue. Ideally, 7 to 10 years is a fair horizon for property as an investment vehicle. If you can hit your profit target earlier, sure, it's all good. Nevertheless, be prepared to hold for the longer term if required. If you're renting and constantly weighing your choices, it's time to pull the trigger. You've probably paid so much rent over the years, enough to cover your down payment and stamp duty many times over even. Try not to do that again for the next cycle. Think of the higher renters now as the final push to commit to a purchase. Overall, it pays to be invested in the market as property remains a unique asset class with the safest, and still relatively speaking, best leverage options. It's one where you use other people's money, the banks, and the tenants to grow your own equity in the long run. Remember, while interest rates may fluctuate, your loan amount can only go down in time. Coupled with inflation, which generally results in gradually increasing property prices, you have real estate as one of the best long-term investments. It can even double up as a shelter over your head. Not sure what to buy? New launches continue to be popular due to the progressive payment model. As evident from the strong sales in all recent launches, Piccadilly Grand, Live at MB, and again the recent Amo Residence. This table illustrates the difference in repayments between a 1.9% and 3% floating rate. It comes up to just over $600 after full disbursement for a 1.5 million property. Furthermore, that could be 4 to 5 years later when interest rates may even be lower than they are today, and your income as a buyer may likely be higher. Initial years are very comfortable as a large portion of the repayment amount only comes about at TOP. Hence, new launches are attractive as it allows property investment without bearing the full brunt of high interest rates. This is opposed to completed units where your repayments are based on the full loan amount right away. I do serve buyers for resale properties as well, and I realize that most of them are primarily focused on own stay. If you're curious on what are the other upcoming launches to look out for this year, make sure you check out the link above to head to one of my previous videos where I went through all of the exciting projects coming up. Hey, we're nearing the end of this video. I want to close by sharing something I heard from a wise buyer. He said, Dear Jim, I buy property exactly because there's cooling measures in Singapore. Just think about it. If the Singapore government knew that the prices would fall, would they implement cooling measures? It's most likely because they believe in the strength of our Singapore market. Realistically, when we look at real estate across the world, Singapore is by no means a cheap country. Even across the causeway, you can probably get something way cheaper. But for the price you pay, 20% is for the property, 80% is for the intangibles, the security, the environment, the quality of living, the transportation, the education. These are all priceless. Thank you for watching till the end. I'm Jim Tay. You can learn more about me in a link in the description. Remember to like this video, subscribe to my channel. I'll see you in my next video.